Good afternoon. There's a lot of people here. Afternoon. I am Gordon McArthur. I'm the CEO and founder of Beeks Cloud. We are a cloud computing company based up in Glasgow that focus on the financial markets. So I think I've got half an hour and I'll run through our slides and then we've got Q&A at the end. So what do? We are a niche cloud computing vendor. So I guess everyone now knows what cloud computing is, but we operate in a very small section of the very large cloud computing landscape, and we solely cater for people doing automated or algorithmic trading. So if you are pressing buy and sell manually or to buy and sell equities, futures, forex, we can't really help you. But now 80% of the volume generated in the world's markets are created by computers. So 80% of that order flow is interested in our services in some way, shape or form. So we cater for both buy side and sell side institutions, and we have a large retail base as well. So the business actually started in 2011, catering solely for retail clients. So there are hundreds of thousands of clients around the world who will buy small algorithms off of a variety of internet sites and marketplaces and use a variety of trading platforms and can trade the markets 24/5. So there's platforms called MT4, MT5, CTrader, where as a retail investor, you can put 5-10 grand into an account, buy an algorithm, pop it onto a trading platform, and it will make buy and sell decisions for you. And that can put you in the market, especially in the forex markets, which run 24/5. That can put you in the market at 4 o'clock in the morning when you're in your bed and meant to take you out at 5 o'clock. So running that on home PCs or a non-resilient infrastructure can cause a big problem. So that's why people historically used us in the retail space. We still do a little bit of retail, but the growing segment of the business is institutional hosting and connectivity. So our core USP is we are connected to about 180 trading venues around the world. They are exchanges, what's called ECNs in the forex space, futures venues. We just did a news announcement last week about our first foray into US equities with the IEX exchange over New York. So when I say we connect you directly, when we have 9 data centers around the world, and they are picked strategically for the location. So we tend to share data centers with exchanges. So we're in the CME's data center in Chicago, for instance, and we connect you directly by deploying our cloud in the same building. We then run fiber from our edge environment over the internal data center roof and down into the exchange. So it's a secure private network between our cloud and the end exchange. We are the infrastructure as a service guys, so we will provide you network connectivity, we will provide you server compute capacity, we will not provide you algorithms, we will not provide you trading applications. We provide you that platform to run whatever you want on top of that, whether you're a retail investor, proprietary trading group, a bank, a broker, or a hedge fund. So we do the plumbing, which is probably the best place to be. As I say, that's probably a little bit out of date now, but we have probably about 180, 190 different financial institutions around the world connected directly to our cloud. It increases every weekend. We connect more and more people, and that will be a never-ending process. So there's thousands of venues around the world for us to connect to, and more of the direct connectivity connections we get, the better for our business. We service around 200 financial clients now. Probably the VPS or retail side of it, relatively flat, still grows a little bit. The focus is certainly on financial institutions. The business was started in 2011 by myself with my life savings and second mortgage. So we were always privately funded. So from very early days, we had to be profitable. So we've always run it as a profitable business. We continue to do that. I think the slight blip in the numbers was related to IPO costs, which was an expensive business. So that swallowed the profit from last year. But if you look at the Sencost note, we continue to predict strong profits and profit growth. It's a scalable business. 95% of our revenue is monthly recurring. So a client, while it's only 30-day commitment contracts, if a client uses our infrastructure to roll out their trading platform, whether they're a hedge fund or a broker, whatever, They don't tend to move that around. That's a core business. The markets are open 24/5. So there's not a lot of movement off of a platform once we get a client. So it's nicely modelable, and I'm always telling our FD that he's not got an awful lot of work to do in his hands modeling the business. He never agrees. So yeah, I mean, it's scalable. So, once we put capacity in the ground, once we buy data center space, it is a capacity utilization business. But, once we cover our operating costs, then the more and more business we put onto the platform tends to drop to the bottom line. So who do we sell to? Who are our clients? So I kind of roughly break it into buy and sell side. So some of these guys you'll have heard of, some of them you'll have never have heard of, and even we hadn't heard of them before they approached us or used us as a provider. So in terms of buy and sell side, so people like IG, most people in the room have heard of IG. So IG, we've got a long-standing relationship with. They're not a huge client. So if you go onto IG's website and you take their MetaTrader 4 trading platform, you will, when you apply for it and open it, get the ability to apply for a Beeks VPS. So IG, we contract with IG. They will pay for a VPS for us for their clients, and the MT4 platform runs in our VPS, runs the algorithm, and executes directly onto IG. So that's more on the legacy side of the business. But it's a brand name that especially in the UK everyone knows. But actually more interesting to us is people like Audacity Capital. So Audacity Capital are a small 10-man hedge fund based out of the Netherlands, and we had never heard of them until 2 years ago. They bought a server from us online. They trade a bit of Forex, they trade a bit of futures with some proprietary algorithms and some private money. And every month over the last 2 years, they have just bought a little bit more from us. And they're a great little customer for us. They love our product, they're always shouting about it. And they've basically outsourced all of their infrastructure and connectivity to us now. And that's a typical client journey, or a nice client journey that we tend to see. People tend to start small, try the platform, and then scale it up as they grow, or as they move, or close down existing homegrown deployments. And actually, some of our biggest customers now are technology providers. So a broker or a fund will get to a certain size, but what we're finding now is technology partners or application vendors in the space can be an unlimited source of revenue for us. So we do not compete with these guys. So we do the plumbing, right? We do the infrastructure, we do the connectivity, but we don't get involved in pricing aggregation. We don't do any trading applications. So people like Vela and 10 use us to provide the underlying infrastructure that their application sits on top of. So every time they win a client, they will deploy new infrastructure from our portal that supports their clients. So the better they do, the bigger and bigger clients they become. And actually our top 2 customers by revenue are now technology providers. So next slide, I'll touch on the cloud landscape. We get asked about this all the way through IPO roadshow, and we continue to get asked this today. Why can't people just use AWS to do this? And why will you not just get eaten up by AWS or Google or Microsoft? And it's a valid question, but there's an easy way for us to defend our position. So I call it, we're in the niche cloud business. So the reason the big guys don't or can't compete with us is fairly straightforward, really. So going back to the fact that we are housed physically beside the exchange and connect directly to them. So we have taken space in the exchange's data center. AWS and Google and all these guys run their own data centers, so they're not in the same building, right? So they cannot physically patch into them. So if you're not in this right location, you've not got direct connectivity, people looking for low latency trading environments cannot use a generic cloud. I was actually in London on Tuesday talking to a broker who's moving off of Azure. They tried Azure and moving off of us because they're just getting killed from a latency point of view. So the fact that we're in all these buildings, we're directly connected to the exchanges, means that the big guys can't really compete with us. And it's taken us 5 years to get these 180 connections to the exchanges put together. An exchange will only connect to you if there's business or flow from their point of view. They don't just do this stuff for the sake of it. So there has to be customer demand. And it takes 3 to 4 months to get the connectivity live. So when we connected to the LME in London, I was in the back of a client who requested it. LME signed the contract, said no problem. But by the time you put the connectivity in, go through the rigorous testing, was 4 months before that became live. So even if AWS decided, we're going to deploy in CME, we're going to deploy in all these data centers, it would take them years to get the connectivity that we've got. Hopefully, one day they'll just come and buy us instead of doing it themselves. And that's fine. So yeah, so we sit in a niche, and we don't host CRM systems. You can't host email systems in our platform. By default, it's a secure financial network. So by default, everything is closed, right? So you cannot connect to, we don't open the email server ports, we don't know web server ports. So we only allow financial applications on our infrastructure. The service offering is broken into two, connectivity and infrastructure. Infrastructure on the bottom layer there is probably about 80% of the revenue that we get. So that goes from the entry-level servers, 27 quid a month for a virtual private server that you can buy over the internet, and it'll be ready in 10 minutes. We'll send you the login and you've got your VPS. There's various flavors of infrastructure footprint all the way up to dedicated bare metal servers, which our latest iteration is about £2,000 a month for a very large server, all of which you can buy over the website, buy over a customer portal, and within a couple of hours, you will have a login to that server in the CME's data center, the direct connectivity to CME or whoever it may be. And that's night and day from people doing it themselves. Because we don't offer anything that a client can't do themselves. The CME will sell space and power to anyone. If a fund or a bank wants to do it themselves, they can. They can take a rack from the CME for 20 grand a month. They can pay them 15 grand for the connectivity, send 200 grand worth of kit over, and maybe 3 or 4 months later, they can be in a place to place a trade. Our model is, don't do that. That's nuts. Come on over our website, go through security screening. For 400 quid a month, you can buy a server online with CME connectivity, and we'll give you the login within an hour, and you're connected to the CME. So doing it yourself is not what people are looking to do anymore. Latency. So why is latency important? So latency, just to kind of go back to basics on it. So latency is just a measurement of time. It is how long does it take to from the trade origination to trade execution. And it's measured in milliseconds, which are thousandths of a second. And the speeds that we offer is good enough for 95% of the market. So we are not catering for all these crazy high-frequency traders that get all the bad press and are doing weird and wonderful stuff with microwave. That is not our business. We will provide you a platform that gives you about half a millisecond latency from our cloud to a venue. And that's fast. That's fast enough for 95% of market participants. So all this diagram is showing is the difference between using our cloud and using homegrown or on-premise infrastructure. So if you're a fund or a broker in China and you're offering trading capability to your clients, you still have to talk back to New York to source liquidity for the dollar, the euro dollar, whatever it may be. There's lots of liquidity for the Chinese crosses in China, but anything outside, they have to come to London or New York too. So a Chinese hedge fund or broker sitting in China will send an order from mainland China and it will hit New York or London in a third of the second or the blink of an eye, which seems very fast. But in our world, you're going to get killed doing that. Around FOMC announcements, non-farm payrolls, the market could have moved 100 ticks away from your market entry in 300 milliseconds. So you might send an order to buy $1 million, €1 or whatever, and your fill is going to be horrendous, right? Because the market's moved 100 pips away, especially around news items. So when we boil it down, all we allowed people to do is that Chinese hedge fund's algorithm, instead of living in Shanghai or mainland China, whatever, we will put it in New York, we'll put it in London, we'll connect it to the venue, and they will get there within half a millisecond. So your order should get better execution, your slippage will be much, much better. So when a hedge fund or a proprietary trading group go and model all these algorithms and strategies, they need to be able to model the amount of slippage that they're going to get correctly, or the whole point is wasted. So when you boil everything down, that's all we do. We allow people's algorithms to live closer to exchanges. Simple. Why do people use us? Why don't they just do it themselves? Why don't they use a competitor? And I'll talk about competitors later. So the main reason people use us is actually number one. It's reduced time to market. So I kind of touched on it with the CME example. So if you're a bank or a broker with unlimited resources and headcount, you can go and do all this stuff yourself. A typical client will be a 20, 25-man hedge fund, and they have one IT guy. And that IT guy has to support email systems, printers, laptops. He does not have the specialist skills that are needed to support all this stuff. So if you're a fund and you think your algorithm is working on the LME in London and you want to go and try it in Chicago, waiting months and months for your IT guy to deploy that infrastructure while you've got an algorithm that's showing good promise, and the algorithms don't last forever. They become profitable and less profitable. You're burning money. So all we allow people to do is, on a 30-day commitment, try algorithms in any place in the world, or if a broker's wanting to target clients in China, they can put infrastructure with us in Hong Kong. We can spin it up. We can spin it up within a couple of hours. And we've recently released our partner portal. So we have moved that on to the next level, where we give clients the ability via a single pane of glass over the internet to see what infrastructure we have deployed around the world. So they can pick and choose themselves, press a button, it'll deploy, and it just adds to the billing. So we can take that time to market down greatly. Low latency I've covered. So 95% of market participants are happy enough with the speed and performance that we can provide them. So we have got a great connectivity footprint now. So, anywhere between 180 and 190 venues plumbed in at the moment. We've spent a lot of money recently on putting in a wide area network. So we now connect all of our data centers around the world by point-to-point fiber. We don't run that ourselves. We go to specialist carriers. So one of our bigger deals recently is we are now allowing one of the large US exchanges to send a Forex pricing over our network it originates in New York, but they are sending it to the Japanese market, and it comes out in our POP in Tokyo, and then they take it from there. So it's a growing area for us, is that kind of low latency, wide area network footprint, and we continue to connect our data centers up with more and more capacity. We've got a range of different trading infrastructures, as I previously said, anywhere from 27 quid a month for very entry level up to £2,000 a month for our biggest server. We have a limited ability to provide you market data. So if you're specifically in Forex and equities, getting connectivity and infrastructure is a big part of the battle, but all of the exchanges will charge you for market data and charge you handsomely. So at the moment, we are a service provider for the CME, service provider for the LME, IEX exchange based in New York. So we can provide you the CME data, and we charge per server per month. We talk internally about expanding this out. So equities is the big part of our portfolio that we don't cover properly, I would say. So the business started in Forex. We acquired a company in 2015 that gave us futures capability. We do not have a wide footprint in equities yet. And the reason for that is every equities exchange, to do equities properly, you need to talk to every equities exchange. And an equities exchange will charge you 30 grand a month per exchange to resell their data. So if we wanted to go and do Eurex, NYSE, NASDAQ, LSE, SGX, that's 150 grand a month of market data fees before you've got a client. So that was always a call that we decided not to make. So it's maybe an area that we'll look at in terms of M&A to flush out that area, because people want market data from us. Liquidity spread. So especially in Forex. So pre-2008, if you were a medium-sized hedge fund, you could probably call up UBS and get a line of credit. You probably could, depending on your balance sheet. After 2008, that doesn't happen anymore. So unless you've got $1 billion plus on your balance sheet, you can't get a line of credit. You can't get an account with any of the tier one banks. So there's a whole phenomenon sprouted up called prime of prime and prime brokers, who will take the mid-tier, our client base, and give them a line of credit without some of the capital constraints that the big guys need. And that plays into our hands, because instead of a hedge fund connecting or a broker connecting to one liquidity source, they're now connecting to many more to try and get the liquidity that they need. Security. So we've spent, and people ask me a lot today, what keeps you awake at night? And security and uptime is the big things. So anyone in IT and financial services IT who is not worried by security is just not thinking properly. So we have spent a lot of time and effort and money over the last 18 months building security into our network. So we have launched an anti-DDoS platform. So DDoS is when people try and kill a network by flooding it with traffic. Particularly problematic in our area. So if you're a broker using our infrastructure, your own infrastructure, doesn't matter whose, you've got algorithms constantly executing trades, buy and sell 24/5. If your trading environment comes down and an algorithm is in the market and can't get out of the market, you're liable. Well, you're liable for that the loss that the client, the difference in when the client tried to execute the trade until when they get out. So we now have an anti-DDoS offering that we built ourselves, and we now charge clients for it and don't allow them on the platform unless they buy it. One of the other key areas is support. So as I said, we only cater for financial markets clients. We have a 24/5 network operations centre up in Glasgow, just outside Glasgow. Every one of our engineers knows financial markets. They don't know CRMs, they don't know email systems. If a broker has a problem, they call or knock and they will get someone knowledgeable on the phone who can help them immediately. Compare that again to a generic hosting provider, a cloud provider, no chat. You can't even talk to them on the phone. So again, another reason why people use us as a provider in the area. So we have competitors. That big blue comment took 2 months of proving with our lawyers. So we had that in our IPO pack. So we believe that Beeks is really the only pure play cloud provider in our world. And what I mean by pure play cloud provider, you can come onto our website, you can buy infrastructure in real time and a 30-day commitment. If you go onto our competitors' sites and you can see you cannot consume services from them on a real-time basis over the web, you can with us. So that is our core USP. It's all about rapid deployment, as I said, flexible, really unique international footprint. Competition is broken down into 2 parts. Generic cloud providers like AWS, like an IMR or Google Cloud Compute. Talked about it, it's not genuine competition. You can use them, there's nothing stopping you using them, but we tend to find people who have tried using them will come back or will come to us eventually. So what's to stop people coming in and eating a little guy up? So it's niche. You need to understand the market. You need to understand the demands of the market. You need to build your cloud out with low latency in mind. We've got very specific hardware that reduces the time between trade origination and trade execution. It's not cheap to do this. You need to spend a lot of money up front to put the capacity on the ground, and then you fill it and you eventually make money. And you need to understand the market. As I said, phoning up a generic cloud provider and expecting them to help on a market data issue just doesn't happen. And this is really the key one. I go back to very early in the presentation. If you're not in the data centers that matter and you're not connected to the exchanges, you cannot offer the products and services. People can try it, but you're trading over the internet, which just doesn't work. It's not secure. Business model. It's monthly recurring business, so 95% of our clients are paying monthly for resources, 5p annually advance, and get a small discount for doing so. The business is moving more and more to institutional. Pre-2014, we were 100% private client. We will go, end of the year, we'll probably 90% of our revenue will be from institutions, and it's all recurring. The white labeling of the Beeks VPS platform is still a nice business with the IGs and FXMs of this world, but it's not really the focus. The focus is institutional. We have our biggest client, and I do like this about our business. Our biggest client is 4% of our monthly revenue. It's a cloud model. We are not going to have lots and lots of sales guys running around very expensive cities around the world. Most of our business comes from referrals from exchanges, venues, brokers, whatever it may be. We've just employed a new commercial director, but we will not have a huge sales team. Sales cycle can be the same day. If people are starting small with us, £1,000 a month, they don't wait months and weeks to make decisions. They'll just go and do it, and hopefully they then grow. So sometimes it can be quite scary when you look at the sales pipeline and think, it's not huge, but then you get a deal that comes in and closes in the day, and we don't get huge visibility months in advance. And we've launched a portal to take the next step in terms of time to market and client ability to deploy. The strategy has not changed after IPO. The reason for IPO was more a credibility exercise as we go up the food chain and deal with bigger and bigger clients. We're looking to expand the amount of services we offer, more locations. We're looking to scale the business. We're looking at new asset classes. We made an announcement recently about going into crypto with Gemini Exchange. We first foray into US equities with IEX that we announced last week. So we'll continue to do that. And we're looking at new geographies. We'll probably deploy into some new geographies over the summer. And quick look at the numbers over the last few months. So we measure a couple of key metrics. Overall new clients, EBITDA, profit. What we tend to see when we onboard a client, that they tend to start small and they tend to grow. So I think this is committed revenue up until our last announcement. So at the end of December, the run rate business was about £6 million a year revenue. That's grown quarter on quarter. Hopefully that will not slow down. And we've got a nice steady increase. We look to sign depending on which month, it's sometimes seasonal, our business, between 2 and 5 institutions each month, and that smoothed itself over the course of the year. The close revenue was up 40% year on year. Gross margin increased to 46%. We measure the business from an EBITDA and a gross profit point of view, so we're up 92%. I think the same cost notes on the public-facing notes will show a forecast of 1.8 for full year at an EBITDA level. And we have cash in the business.
You're forecasting a dividend?
Yes. So I'm a 65% shareholder, so yes.
And what's your Forex exposure?
We don't actually, so we bill half and half. So a lot of our clients are US based, so we bill in dollars, we bill in pounds as well. So it's about 50-50 split, and we've kind of got a rough cost base of 50-50. So we see a little bit of fluctuation, but the pound dollar doesn't cause us a huge amount of problems. And that's a kind of current global footprint at the moment, which will expand. Year ends June. It's a recurring business model, so it's not like a software business where you're looking for the last month to try and close the big deals. We know where we are early.
Just one really quick one.
Sure.
How big is the addressable market? How much can you grow?
It's a good question, and it's a hard question to answer. So we deal with 200 institutions at the moment. We think at any one time there's around 10,000 hedge funds in the world. That varies because they do well, they do badly. There's about 2,000 Forex brokers around the world. There are up to 500 Tier 2 and Tier 1 banks. So we deal with 0 Tier 2 and Tier 1 banks. So that's a huge market for us to move up into. We have less than we are only scratching the surface. Can I give you an exact number? No, but it's big. It's big.
Just a quick one. Could you explain the latency point again? Because if I've got a computer in Shanghai, I'm at point A.
Yep.
The CME is point B.
Yes.
One way or another, the signal's got to get from point A to point B. And why are you faster?
Well, so bear in mind it's an algorithm that's making the trade, right? So all we are saying is move the algorithm to Chicago. Don't have it sitting in Shanghai.
But it's still going to steer the algorithm from China.
No. So an algorithm is a self-contained trading engine. It will make the buying and selling decisions. People can log in from Shanghai and view what's going on, but that latency is not important for that. What is important is getting the trade from origination to execution quickly. And that happens, the algorithm sits in our server in Chicago and does a very quick hop. And then people are watching from Shanghai, but the trading's not going all the way around the world.
Hi there. Is there any sign of any of the large banks who've done direct connectivity looking to leverage that tech investment and provide that as a service to the market?
Yes and no. That's a good question. Yes and no. Cantor did it. Cantor Fitzgerald did it. They had spent so much money on building out their infrastructure for Forex. They created a side company called Lucera, a competitor of ours. They are the only ones that we have seen that has tried to monetize that investment. what we are seeing is the big banks, the JP Morgans and the Citibanks, trying to outsource all of this stuff. So if you look at, so I mentioned Fixnetics, one of our competitors. Fixnetics, now part of CSC, their core market is outsourcing tier one banks' infrastructures. And they deals are massive, 25, 30 million quid a year. After 2008, again, the headcount shrinkage in the bigger banks hits every part of the bank. So instead of having highly paid engineers that work directly for Deutsche or Citi or whatever, the banks are tending to outsource it. So one of the reasons for IPO, as I said, is to expand our credibility, PLC status, strengthen the balance sheet, to try and gradually step up the food chain in terms of the size of institutions that we deal with. But no, we don't see banks doing it the other way, other than Cantor. That answers your question.
Michael Lewis wrote a book on all this.
Yes, he did.
And it was a really fascinating read.
Yes.
Digging the pipes through the Rockies and all that stuff. But one of the points that I got out of the book was that there is a case for jurisdiction to ban automated trading.
Wow.
That it's a totally artificial situation and it totally distorts marketplaces.
Yep.
So is that a growing leverage, a decreasing leverage, or how do you see that?
You need to differentiate between high frequency trading, which Michael Lewis was talking about, and automated trading. Okay. So when I say automated trading, no, vastly different. Okay. So someone like this who are doing classic HFT are doing thousands of trades a second, right? They are front running orders between exchanges, right? That's what they're doing. Now, you cannot do that in a shared platform, right? So if you're an HFT, there only is 4 or 5 HFTs left in the world. It's a very much a shrinking market. So we do not cater for HFTs because, we are, we get thousands of clients using our platform. Everyone gets the same speed. So when I say automated trading, that might mean one trade a week. It's just the engine is making the decision. It's not trading thousands of times a second. HFT, predatory trading, front running, is a dying business. And if you look at all the big HFTs are merging because the exchanges have got a bit wise to it all. So if HFT disappeared tomorrow, it would not affect our business. In fact, it would help us a little bit. So it's not something we're involved in.
In terms of talk about CapEx, looking
Yes.
at CapEx as you go forward, in terms of as your number of clients increases and you're putting more kit into the exchanges and opening up, talk about what percentage of revenue and what you expect over the next 12, 18 months.
Yeah, sure. So we spent a lot of time on this in our note, which in the Senkos note, which I know you guys don't have access to, which we're trying to resolve. So we have at the moment built capacity and got the operational spend in the business for about an extra £3 million of revenue per annum. To get that £3 million of extra revenue, the operational cost is pretty much covered. We've probably got about £1 million of capex spend that we'll need to invest to build out, to fill the racks up. And our model really is at any point in time, we have about 200 servers of capacity around the world ready, waiting to go. So what we don't do is just buy thousands of servers and spend it all at once. We've got because it was private investment, we run it in a very Scottish fashion, I call it. We don't throw money at servers just sitting waiting. So yeah, to answer the question, it's about £1 million worth of capex, and we reckon that gives us about £3 million in the top line. And a lot of that drops to the bottom because the operational spend is already met.
Thank you very much.
All right, thank you, folks.